Perfect timing this morning, guys. Right when I'm about to press record, something just went in my left eye. Well, happy Monday, everybody. Hope everyone had a nice weekend. Welcome aboard to the Morning Note. My name is Carlos Garcia, founder and CEO of GAR Capital. It is December 12th, 2022 on a Monday. Let's go ahead and get started. As you can see in terms of the actual headline that I wrote, the futures are green this morning. We'll go quickly around the horn, and then we're going to start charting some scenarios for tomorrow. Since tomorrow is such a big day, how big of a day could it be is really the question everyone is really wondering. What's the implied move? What could we get? This is I sent from Bloomberg to the actual Discord channel of the market blog. Again, S&P could rise as much as 5.5% or fall as much as 6% on inflation day. If you are signed up for our newsletter, I went ahead and actually talked about the previous times that we had CPI and the market reactions from it. If you didn't get that email, I sound like I'm in Office Space. Did you get that memo? I just dated myself. Sorry, old movie, guys. But yeah, that email again. If you're not part of the subscription in terms of the email that we send out newsletter every week, it is free. Feel free to take a look at our website, garcapitalfx.com, so you can go ahead and sign up at least for the free newsletter, so you get some information throughout your weekend. So with that being said, a 5.5 implied move. That's big. Last one of the year. We have the last CPI of the year, last FOMC of the year, last OPEX of the year. Boy, and not only that, go ahead and throw in a little bit of ECB. European Central Bank is also going to vote on their rate hikes as well. Have fun. Round the horn quickly. Dow futures up 66, Nasdaq up about 0.22, S&P 39.77. If you were watching futures overnight or over the weekend, you may have seen a little bit of a disparity. And why do I say that? Disparity between the symbols. Right now, the active contract, the one that we're watching, is for March 23 expiring. There is an active contract that is going to expire on Friday, OPEX. That's ESZ22. That is a December expiry, but TOS went ahead and moved the actual active contract to the main portal as ESH23, H being the symbol for March. I know it gets a little confusing. We talk about that on the futures course on our online website, excuse me. 39.78 is your current ask price. 39.78 and a quarter. That's your current ask price. You can see there's a disparity between December's and March. So again, if you did see on Friday, we did close around 39.30. We did jump or 39.30 or so. So 39.46 seems to be the correct level where you were. So if you're charting it based on the December expiry at close on Friday to today's active contract to March expiry, you're thinking to yourself, wow, Carlos, we gapped up 30 points. That's not the case again. So we're just rolling over now. That's the active contract based on Thinkorswim platform. So again, if you were trading futures or you're having a long position on futures, make sure you have the right contract moving forward so you're not confused. That's something that's super important to go over. So again, Dow up 68 and NASDAQ up about a quarter point. So was the S&P. Russell about 0.17, underperforming the majors. Crude oil up 0.44%. Gasoline down about 1% this morning. Silver futures down about 0.5%. Gold futures are down as well, even though the dollar is relatively flat to down. So again, gold being down, even with the dollar being down, is telling me that a little bit more of a risk-on feel, as that's why the NASDAQ is a little higher today. Copper down 1.34%. Interesting to see that, especially with S&P SPOOs green. Usually copper and SPOOs are working hand to hand, very closely correlated, at least lately. Euro dollar, that is up 35 pips this morning. That's been very correlated with the S&P 105.68. We're still kind of hoping for 106, get above that. 137 even on the dollar yen, that is up 42 pips. Pound dollar is up 37 pips, 122.95. So again, the dollar pulling back slightly. We'll go over that chart here in a second. Bitcoin still hovering around, pretty much dead money right now in the past 3 months or so. Sure, we had a couple legs down, but right around 17,000 is where we're hovering. Bitcoin made a record. Well, I guess you want to call it a record or an interesting statistic. If you held Bitcoin for at least 5 years, this is the first time in the 5-year cycle that it is red. Keep that in mind. Testing all the hodlers out there. I'm one of them. 1244 on Ethereum, down about 1% this morning. Again, moving a little more of a higher beta. If we made beta Bitcoin, again, if you did the correlation between Bitcoin and Ethereum moves a little sharper. That's all. The big thing that stood out to me today was the volatility index, up about 666%. Not exactly nice to read. 2435 this morning. Again, that's where we are right now. So let's start charting it. Let's go to the volatility index first. That's the first thing we're going to do, since that's the last thing we just spoke about. So again, daily chart. We've talked about this for a while now. Again, a little bit of a repeating, but with such a big day tomorrow, I think everyone should be ready to go. So again, we have this rising trend line here. We broke below right around August. We tested that low in August as well. Keep in mind, when August here, when the VIX was right around 1922, where was S&P futures? Let's go and take a look. Right around that date in S&P futures in August, we topped out right around 4,300. So again, I'm going to give you a little bit of the bear scenario here. So let's start with the bear scenario. Let's start with the worst case scenario. Again, the volatility index being elevated, or again, we're kind of knocking our head on that trend line. And again, this is on a weekly chart, mind you. So again, you could see we're above the 100, we're above the 200. And again, the saying goes, nothing good happens below the 200, but now we're above that on the weekly. So again, a big gap to fill here. That could fill, obviously, again, you do have this trend line resistance. Last time we were below that trend line, guys, and below 22 on VIX was the August peak. So again, this could be indicating of a bear market rally, or it could be indicating a reversion of the mean as we're getting closer to a CPI number tomorrow, a very important one. Let's go to 10-year yields, very, very important. As we know, again, the head and shoulders pattern has been working so far, but again, remember back in August, we're getting back to that August peak in the S&P, that bear market rally. We got as low as around 2.575%. Again, from peak, you got a peak of 34.88 to around, let's call it 25.75. So again, a big, big jump. You're talking about nine. Let's just call it $9, right? If we're talking TNX, we are now around 8 from the peak to drop. So again, percentage-wise is not the same, but again, dollar-wise is pretty close. The only thing that's standing out here is, again, that fib level right here. That's what we're looking for that break on TNX. Again, with this head and shoulders pattern, we expect at least to get back to 32. But again, this could definitely hold up and spike as well. There's no really other gaps to fill. Let's go and take a look at the daily to give us a little more color. Okay, there is a gap to fill around 36.85. That could fill tomorrow morning if we get some kind of panic move like we did in October on CPI. But we're holding steady of that 100-day moving average, which is very equal to the peak in August. So we just hit the peak. We hit the bottom on VIX, at least temporarily below that trend line on the August peak, the correlation, right? I think we got to around 18 on VIX. We were around 19. So again, we're starting to get to the point where we're matching levels where the August peak was on S&P futures. That's yields and that's the VIX. Let's go to the dollar. How about the dollar? Let's see. August lows. You bet. We're right there, right at it, man. 104.86. Again, we're looking for that 105 break to hold and sustain. But the big level we want to break that big 104 level. The dollar is right now, this would not be a bear case, at least here, since there is no upward gaps to fill. The dollar just keeps falling. This is deflationary talk here. So again, once we get to around 104, that's a very, very strong trend line. Why do I say that? Because if you expand it back to let's go to the max chart weekly. And again, I put that arrow there to show that we also have another in between or a rising wedge or a channel, if you want to call it. I would not call it a perfect channel because if longer we increase it out, it'll interconnect. So it's more of a rising wedge. If we can break below that rising wedge, that could give us a lot of solace in the stock market with the dollar going down. Make no mistake about it, guys. At the end of the day, inflation is falling. I mean, the PPI number, the expectations is one thing, but again, inflation is falling. The peak of inflation was in June. We had gas prices at its peak as well, housing at its peak. Again, we're starting to get rents to fall a little bit, not a lot. Used car prices falling about 17%. I talked about that on the newsletter as well from peak. So again, we're getting a lot of deflationary forces. I think what the market has, just like anyone else, guys, is two things: perception, perspective. Perception and perspective being the same, and the second thing being expectations. Everything is all about expectations, whether it's sports or whether it's the stock market, economic news, you name it. There's always expectations, right? Favorites and underdogs. I would know the Cowboys were 17.5-point favorites against the Texans, and we barely won. But again, those are expectations. A win's a win, right? Well, not in the stock market necessarily. Again, you have the expectations for CPI. Let's go over that number rather quickly. We could see the CPI number tomorrow. 0.4% is the previous number. Let me see what the forecast is. Let's go here to forecast being 0.3%. That'll be the month over month number, the headline number we call it. CPI being the year over year. The previous was 7.7. We're at a forecast of 7.3. So again, really what we want, I guess for me anyways, is can we still just get below 7.7? 7.3 would be terrific. The month over month number, guys, be careful. That number might be negative. Think about that. Again, we've had that before with PPI, negative reading month over month. But again, the big number where everyone's going to be talking about the headline number or the Dow number. Everyone quotes the Dow. I know I do sometimes. Year over year, again, 7.3 is our forecast. Core, strip out the autos and gas on that one. That is 0.3% on the forecast, pretty much in line with these regular CPI month over month. So again, we talked about auto sales. Looks like the market is kind of discounting that already. So again, it's not any kind of new information in terms of CPI or what to expect. But again, what we're trying to do here, we want to see if is inflation falling. If we're higher than last month, that is bad, obviously, in terms of the year over year basis. That's pretty much your bear case scenario. If we beat expectation to 7.3%, at least on the headline basis, we should get a sharp relief rally, obviously. But if we go back to the, let's see here, where is there? Let me go ahead and go over the PDF. Here we go. All right, here is the actual info. This is the newsletter we sent out. It looks a lot better on the phone, I promise. But this is just a PDF based on the phone. So again, let's go over the last CPI reports that we had since September. September 9th, worse than expected on terms of CPI. The SPX had its worst day in 2 years. So again, obviously a bear case in mind. October 13th was worse than expected. Futures crash and then engage in one of the largest intraday reversals ever. Have fun. And then the 10th of November, better than expected, SPX had its best day of the year. So bears have one, bulls have one, and the, I guess you want to call it neutral, right in the middle. I guess this is the big one, obviously. We'll see if we get the continuation of the trend down in terms of November and October, at least from October, November on, and we continue that trend to the downside, more deflation, again, lower commodity prices, lower dollar, and that would constitute a soft landing if we can get unemployment at least. I think the Fed number, what they're expecting is 4.5% in terms of a soft landing. We're right now at 3.5, 3.6%. The labor market is still strong. That'll still add inflationary pressures. I would not expect the moon. I expect inflation to decelerate or deflation to really start cooking in 2023. But again, this is the last month anyway, so that's not much of a stretch. So that's what we're looking at. In terms of the bear market the bear market scenario, let's take a look at it on the daily. And again, I think this is pretty much the chart everyone's been looking at. Again, the trend line from April, we know the drill, we tested it, we rejected it. We're still above the 100. We're still below the 20. So at least that. Any kind of gaps to fill, we're going to go and take a look here at SPX. This is the cash S&P 500. We have a nice gap to fill here. Could that be filled as well? That's your bear scenario. That would be right at 38.40 or so. That'll basically retest the previous CPI breakout, which is completely probable. 38.40 or so, 38.20. That's your S&P 500 level. That is right at the 50. That'd be a great target if you are shorting ahead of it. Good luck. Very difficult. We'll see what we get. But in terms of the gap fill, that's the only one that stands out. So again, we don't have any upside gaps below the trend line. The only upside gap we have is 42.16. Could we get there with a great CPI number? Possibly. But I wouldn't expect that. 4,300 is my bull case scenario in terms of the market. I still say that we'll hit the lows of the stock market, if not at least a year. At least that prediction will hold up. But 4,100, I think with a great CPI number, deflation, again, showing lower month over month, year over year, I think that with put call ratios being so high, we're going to go over that here in a second. Here's your put call ratios on the daily chart. And again, you're starting to see these kind of spikes. And again, you could see the spike higher. We had the highest in terms of put call ratio since 1997. Again, this printed higher, obviously in May. But in terms of a settled candle, it was the highest since 1997. That was the 154, right around 12.7, and we still chopped around for the week. So again, maybe the bears don't care about the put call ratio. Who knows what is expected moving forward? But again, that right there, that gap to fill is your big level, 38.23. Could we get there? Boy, that 100-day has to hold. That's your big moving average, 39.29. If we can hold above that, maybe. But again, some hedging could be possibly be in play. But again, there's so many moving factors here. The CPI is only one part of it. We also have the FOMC and Chair Powell on Wednesday, and then OPEX on Friday. So again, guys, let's not add too much risk on the board ahead of time. If there is a lot of money that maybe you made this rally from October, November, maybe you own a Netflix or any kind of the Chinese names that have been absolutely soaring since the bottom of October, maybe look for a place to take some profits ahead of time, start hedging a little bit, because this is a very binary event. No one really knows what to expect, let alone the reaction. So again, guys, let's just take it easy. Let's see what we get. Maybe if we get above 39.87, we could squeeze out a little bit of juice and then just have a little bit of a call contract running. Maybe we can break that 100-day moving average. We can play some shorts, maybe to 3,900, leave a runner, and so on and so forth. The idea is to keep the risk down. That's very important, guys. Anything can happen. And as we know with the market this year, will happen. That's where we are. Bears and Bulls have great arguments. I know me, I'm a little more on the Bull side. What else is new? I still think that we get that Santa rally, but if we expect that Santa rally, tomorrow is going to be the first step. If not, no dice. Coal in the stocking. That's where we are. All right, so let's see. Good morning. Good morning. Austin saying Boyle. I don't know what Boyle is. Costco. I know what that is. COST. Let's take a look at it. I own Costco. It's one of my top 10 stocks of 2022. Not a lot of great options out there, but Costco's been okay. Got some upside gaps here, right around 522. In terms of Costco, what I buy, again, to add a little more, you have that gap fill here right around 443. I think that's a pretty decent level to go ahead and add a little more Costco. The only way I would probably add more is if you get a breakout above. But again, you could see here, inverse head and shoulders. Maybe we go ahead and retest that neckline and then bounce as well. Again, Costco is expensive. That's the only problem. I'm not talking just the stock price. I'm talking about price to earnings, guys. These value companies that everyone has been piling in, Coca-Cola, Pepsi, the kind of the value names, Procter and Gamble's of the world, they're starting to get expensive. Just like anything else, guys, things just get to the point where the price is so high, demand is just going to go down. You can't just people are just not going to, funds are not going to just pile into Coca-Cola just to make 2% yield. Again, the idea is these hedge funds have some edge, and again, they want growth. Now, even if loss comes, but again, I think the hedge fund customers or the hedge fund clients, they don't want to pay just to own Coca-Cola. They could do that themselves. Obviously, you have derivatives and other kind of trading involved with it. Once we start getting yields to fall, guys, keep in mind that the Fed cannot keep rates this high. Keep in mind, the last time we had rates this high was in 2007. In 2007, we had half the debt we have now. It's not sustainable. It just isn't. So again, I expect a deflationary issue to happen. The problem with that is that can cause a severe recession. Deflation is not good. Think about 2008 after the crash, 2009. We were in a deflationary bottom at that point because demand was basically sunk, unemployment spiked, the housing market went right. We know the big short and all that. The value stocks are not immune to that, guys. Expensive is still expensive. People are going to try to take some money out of the market. Costco may be one of those. Let's see if 443 comes. If that's the case, again, we're talking 2023 now. We'll preview 2023 as we move forward towards the year. But as of right now, CPI is in effect, and that's what we're looking for. But again, 443 is a level that I would want to add in Costco. I own some. I actually have a Costco membership. They're great. Carlos, thank you for doing this daily. You're very welcome, Thomas. Thank you for watching daily. Adobe, a play for earnings. I would kind of stay away from earnings here, but there is a gap to fill. So keep in mind here, right around 366, if you're one to play the lotto, if you're one to play earnings, 360 would be a great target. That's the gap to fill. And you got another one on top of that, right around 400. I don't want you to give your premiums away either. So again, if you do see some volume, if you see at least some traction, maybe a break of 347 today, I would highly doubt it jumps $12. But again, you can target if we continue higher on S&P, since Adobe is a part of it. not a big weighted part of it, but a technology sector nonetheless. 347 is your resistance at that 100-day. Let's see, another possible leg up for NEO. Again, the China stocks are all going to be on the same issue. It's all about lockdowns. It's all about the COVID stuff. NEO will only go as high as the Hong Kong exchange will allow it. That's pretty much where we are in terms of the COVID lockdowns. I believe Hong Kong kind of relieved some some China lockdowns or in their province. That's really the only way NEO and Alibaba, which I own both, can go a little higher. In terms of how high they can go, you got one more gap here around 1470. That might be the peak of the year, unless they just stop the lockdowns, and then again we could talk about a $20 stock here. Some good upside on NEO, but again, it's all that China stuff, and it's so again macro based. Let's see, Alex. Thank you for the hands. Appreciate y'all. Okay, guys, it's 9:20. We're gonna go and leave it there. In terms of the bull case, we know the drill. It's a binary event. We do have a gap to fill to the bottom, guys. So again, be very careful as we go. We'll go over the CPI number tomorrow at 9 o'clock in the morning here on the YouTube channel. Make sure to turn on notifications so you don't miss that. So much going on, guys. Again, the only thing I can really say here is to be patient. There's no need to give money away on premiums. I've done that. Let me make the mistakes, okay? I'm okay with that. Don't do it. Just chill out. Let's see what you get. Kind of stick with the high volume names. But again, everything in terms of calls and puts, guys, are going to be juiced because the implied volatility is so high. The S&P 500 is either hit or miss, either up 5.5% or down 5.5% as much post CPI. It's basically a roulette wheel. Be careful if you are going to trade this. I wouldn't expect much other than positioning. Have a great rest of your morning. I will see you guys tomorrow. Let's make it a great one. Cheers.